Welcome to Canada Wealth Guide, your go-to channel for personal finance and investing in Canada. In today's video, we'll explore how to start investing in 2024, even if you're completely new to it. Whether you want to build wealth, secure your future, or reach financial independence, this video will help you take the first steps towards a strong financial future. Step 1. Set your financial goals. Before you begin, it's important to know what you're investing for. Are you saving for retirement, buying a house, funding your child's education, or growing wealth for financial freedom? Your goals will dictate your strategy. Think of it like choosing a destination for a road trip. If you don't know where you're going, any road will get you there, right? But you might end up somewhere you don't want to be. Same with investing. If you don't have a clear financial destination in mind, you might end up taking unnecessary risks or, even worse, not investing at all. Take some time to really think about your short-term and long-term financial aspirations. Do you want to retire early, travel the world, start your own business? Once you have a clear picture of what you want to achieve and by when, you can start working backwards to figure out how much you need to invest and what kind of returns you need to aim for. Now, once you've identified your goals, write them down. Studies have shown that you're more likely to achieve your goals if you write them down and review them regularly. Make your goals specific, measurable, achievable, relevant, and time-bound or SMART goals. This will help you track your progress and stay on track. So grab a notebook, open a spreadsheet, or use a goal-setting app. Step 2. Choose your investment accounts. In Canada, we have some awesome tax-advantaged accounts that can supercharge your investment journey. Think of them as turbocharged savings accounts that help you keep more of your hard-earned money. We're talking about TFSAs and RRSPs. First up, the TFSA or tax-free savings account. You contribute after-tax dollars, meaning you've already paid taxes on that income. But here's the kicker. Any money you make inside a TFSA, whether it's from interest, dividends, or capital gains, is completely tax-free, even when you withdraw it. Now let's talk about RRSPs or Registered Retirement Savings Plans. Contributions you make to an RRSP are tax-deductible, which means you can reduce your taxable income for the year and potentially get a nice tax refund. The money you contribute grows tax-sheltered, and you'll only pay taxes when you withdraw the funds in retirement. And hey, don't forget about non-registered accounts. These are like the Wild West of investing, no special tax benefits, but also no restrictions on how much you can contribute or when you can withdraw. If you're just starting out, maxing out your TFSA is usually a good idea because of its flexibility and tax-free withdrawals. RRSPs are great for those in a higher tax bracket or those who want to reduce their taxable income today. Step 3. Pick your investment type. Okay, so you know why you're investing and where you're going to put your money. Now let's talk about what you're going to invest in. And trust me, there's no shortage of options in Canada. Let's start with the OG of investing stocks. When you buy a stock, you're essentially buying a small piece of ownership in a publicly traded company. Stocks have the potential for high returns over the long term, but they can also be volatile in the short term. Next up, we have bonds. Bonds are like IOUs issued by governments or corporations. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the return of your principal investment at maturity. Bonds are generally considered less risky than stocks and can provide a steady stream of income for your portfolio. Now let's talk about ETFs or exchange-traded funds. ETFs are like baskets of investments that track a particular index, sector, or asset class. For example, you can invest in an ETF that tracks the S&P/TSX 60, which is comprised of the 60 largest companies listed on the Toronto Stock Exchange. ETFs are a great way to diversify your portfolio with a single investment and are known for their low fees. The key here is to choose investments that align with your risk tolerance, time horizon, and financial goals. If you're young and have a long time horizon, you might be comfortable taking on more risk with a larger allocation to stocks. Step 4. Open an investment account. Alright, you've set your goals, chosen your investment accounts, and decided on your preferred investment types. Now, it's time to open an investment account with a brokerage. Think of a brokerage like your gateway to the financial markets. It's where you'll buy, sell, and hold your investments. In Canada, you've got two main options: big banks and online brokers. The big banks like RBC, TD, and Scotiabank offer a wide range of financial products and services, including investment accounts. They're like the department stores of finance, convenient, familiar, but sometimes a bit more expensive. On the other hand, we've got online brokers like Questrad, Wealthsimple, and Interactive Brokers. They typically offer lower fees and commissions, which can save you a ton of money in the long run, especially if you're planning on buying and selling frequently. When choosing a brokerage, consider factors like fees and commissions, account minimums, research and educational resources, customer support, and the platform's user interface. Do your research, read reviews, and compare different options before making a decision. And here's a pro tip: set up automatic contributions to your investment account. Step 5. Build your investment portfolio. Alright, you've got your account set up and you're ready to start building your investment portfolio. Remember the saying, don't put all your eggs in one basket? Well, that couldn't be truer when it comes to investing. Diversification is key to managing risk and maximizing your chances of success. The same principle applies to your investment portfolio. You want to spread your investments across different asset classes, sectors, and geographies. This helps to reduce the impact of any single investment on your overall portfolio. So, how do you actually diversify? Well, you could start by investing in a mix of stocks, bonds, and ETFs. You could also consider adding real estate to the mix. And within each asset class, you can further diversify by investing in different sectors and geographies. For example, within stocks, you could invest in technology companies, healthcare companies, financial companies, and energy companies. And don't forget about geographical diversification. Consider investing in international markets as well. Remember, building a diversified portfolio is an ongoing process. Step 6. Stay consistent and educate yourself. Congratulations, you've made it to the final step. You've set your goals, chosen your accounts, picked your investments, opened an account, and built a diversified portfolio. You're well on your way to achieving your financial dreams. But here's the thing. Investing is a marathon, not a sprint. Consistency is key when it comes to building wealth over the long term. Make it a habit to contribute to your investment accounts regularly, even if it's just a small amount. And here's where the magic of compound interest comes in. Compound interest is like earning interest on your interest. But consistency isn't enough. You also need to stay informed and continue educating yourself about personal finance and investing. And that's how you can start investing in Canada in 2024. If you found this video helpful, give it a thumbs up. And don't forget to subscribe to Canada Wealth Guide for more tips on building wealth, investing, and financial freedom. Thanks for watching, and happy investing!